Okay, so if you work in India, your salary is about to be completely redefined by a single powerful number. A really fundamental change is here, and it's going to impact how you're paid, how you save, basically your entire financial future. So let's dive in and decode this 50% rule that's set to change, well, pretty much everything.
I want you to keep this question in the back of your mind as we go through this. Seriously, because by the end, you are going to look at your own payslip in a completely new light.
First things first, we're not just talking about some minor tweak or a small update here. We are talking about the end of an entire era for how salaries have been structured in India for a very, very long time. You see, for decades, companies kind of engineered payslips to have a really small basic pay and then this huge pile of allowances. And the goal is pretty simple. It was to lower the amount they had to contribute to your Social Security, things like your Provident Fund and gratuity. Well, that entire system is now being taken apart.
So, how do you dismantle that old system? Well, the government started by redefining the single most important word on your payslip, wages. Instead of having a bunch of different definitions scattered across a dozen different laws, there is now one single, unified definition of wage. And the whole point is to create a standard, totally transparent base for calculating your Social Security benefits no matter where you work. Simple, right?
Now, the legal definition itself, it's pretty complex, not gonna lie, but we can break it down into three simple ideas. First, the law tells us what's automatically included in wages, like your basic pay. Second, it gives us a list of what's specifically excluded. And third, and this is the absolute genius part, it introduces a balancing rule to make sure the first two parts never get out of whack. So the law creates this negative list, all the things that are not considered part of your core wage, things you'd recognize, like your house rent allowance, your bonus, and overtime pay. Now, this might sound a little bit like the old system, but all of these exclusions, they now come with a very, very big catch.
And that catch? Well, that catch is the heart of this entire reform. It's what we're calling the magic 50% rule.
This one number, just 50%. It literally changes everything. It creates a mandatory floor for your legally defined wage, a floor that has never, ever existed before. Okay, here's how it works. I want you to picture a balancing scale. On one side, you have your wages. On the other, you have all those excluded allowances we just saw. HRA, special allowances, the whole lot. The law says the allowance side can never be more than 50% of your total pay. If it is, any amount that tips over that 50% mark gets automatically pulled back and dropped onto the wage side of the scale. It's a brilliant way to make sure the wage side is always at least as heavy as the allowance side. Let's make this real. Take a look at this example for a 1 lakh rupee salary. In the old days, a company could get away with a basic pay of just 30,000 rupees. But under the new code, to keep those allowances from crossing that 50% line, the basic pay is now forced to go up to 50,000 rupees. And that special allowance has to shrink dramatically to make it all balance out. The bottom line is your statutory wage now has a hard floor.
Okay, so your payslip gets a makeover. Big deal, right? What does that actually mean for your bank account today, and more importantly, for your retirement down the road?
Well, this is the big trade-off. A higher wage base means you and your employer will contribute more to your Provident Fund every month. So yes, your take-home pay might dip a little bit, but, and this is a huge but, in exchange, your long-term retirement savings are going to grow much, much faster. The whole system is now designed to prioritize your future wealth over immediate cash in your pocket. And the impact on retirement funds is so massive that some experts have actually given it a name. They're calling it the gratuity time bomb. And here's why. Gratuity, your end-of-service benefit, is calculated based on your last drawn wages. So for someone whose wage base was only, say, 30% of their total salary, that base now jumps to a minimum of 50%. That one little change can increase their final gratuity payout by a staggering 66%. That's a life-changing amount of money.
And the ripple effects just keep on spreading. This higher wage base also leads to bigger PF contributions, a larger foundation for the higher pension scheme, and, in a really major policy shift, gratuity benefits are now extended to contract employees too.
Now, this isn't just a change for employees. This is forcing entire industries to completely rethink how they do business. Let's take a quick look at how different sectors are going to have to adapt.
You know the IT and services sector? Famous for those complex flexi baskets packed with all kinds of allowances? Yeah, they're directly in the crosshairs. Those old structures where allowances often made up 60 or even 70% of the pay are just not legally possible anymore. They have to be completely torn down and rebuilt.
For the manufacturing world, the big hit comes from overtime. See, overtime pay is calculated as a multiple of your wages. Now that the wage base is legally forced to be higher, the cost of every single hour of overtime, well, it's about to skyrocket.
And then you have startups. They face a totally unique challenge. Many have traditionally used that low-cash, high-equity model to attract talent. But now, the cash part of the salary has to be structured to meet that 50% wage floor, which directly increases their immediate cash burn. And that's a huge pressure point for any new company.
So after all that, let's bring it all back home. Let's boil it all down to what this fundamental shift really truly means for you.
All right, let's lock in the 3 biggest takeaways. Number 1, your legally recognized wage now has a hard 50% floor. No getting around it. 2, the system is now designed to boost your long-term savings, even if it means a little less take-home pay today. And 3, this is universal. Every single company, big or small, has to play by these new rules.
Which, of course, brings us right back to where we started. The next time you get your payslip, look at it and think about that 50% rule we just decoded. So, now that you know, what's the answer to this question?
Welcome to the deep dive. Today we are cracking open a legal and financial transformation happening in, well, the world's most populous nation, India.
And this isn't some small incremental change we're talking about.
No, not at all. This is a fundamental redesign of how compensation works. It affects every single employee's salary structure, their retirement savings, and ultimately their future financial security.
We're diving deep into India's 4 new labor codes,
Yeah.
specifically the code on wages and the mechanism that's really set to end decades of, let's call it, calculated ambiguity.
And that's the mandatory 50% statutory wage floor.
That's the one.
Right. And this isn't just about reading a new law. We really want you to understand that this is a complete financial overhaul. For years, maybe decades, the number that represented basic pay on your monthly payslip was often, frankly, a legal fiction.
It was a number deliberately kept low for corporate benefit.
Exactly. And this new definition, which is now uniformly applied across the code on wages, the Industrial Relations Code, the Social Security Code, and the OSH Code.
The Occupational Safety, Health, and Working Conditions Code.
Right, all 4. This unified definition essentially closes the book on, 7 decades of structured financial arbitrage?
Our mission today, really, is to unpack this singular unified definition of wages. I think we need to understand the historical problem that made such a dramatic regulatory intervention necessary in the first place.
The why.
The why. And then we can analyze exactly how this new law uses pure objective mathematics to enforce transparency and really to mandate long-term savings.
Okay, so let's start there. The historical problem. You called it the wage splitting culture, which I think is a perfect term. Why was the system so confusing to begin with?
I mean, in one word, fragmentation. Pure regulatory fragmentation created the opportunity.
What does that mean in practice?
It means that before these reforms, the definition of wages was scattered across nearly 29 different central labor laws. 29, yes. So the Provident Fund Act, the PF Act, had one definition. The Payment of Gratuity Act had another. The Minimum Wages Act had yet a third one. And this legal fragmentation led to what corporate accountants and HR departments very cleverly termed interpretive dissonance.
Interpretive dissonance. That's a very polite way of putting it.
It is.
And that dissonance, in this case, meant cost savings for the employer, but it translated into massive risk for the employee.
Right, precisely. To minimize their mandatory Social Security contributions, we're talking mainly about Provident Fund and gratuity companies would artificially depress the basic pay component.
How low are we talking?
Oh, very low. They'd often keep it as low as 30% or maybe 40% of the total cost to company, the CTC.
Okay.
And then they would inflate all the non-statutory payments. They label them special allowances or various other customized creative allowance names to cover the remaining 60% or even 70% of the employee's salary.
So let's make that really tangible for someone listening. If your CTC, your total package was, say, 100,000 rupees a month.
A lakh, yes.
And your basic pay was only 30,000, then the mandatory 12% employer PF contribution was only calculated on that tiny 30,000 rupee base.
Correct. The employer only had to contribute 3,600 rupees towards your PF. Now, if the basic pay had been 50,000, which is the new floor, a difference of just 20,000 in the base,
the employer would have had to contribute an extra 2,400 rupees every single month.
Exactly. By keeping that massive 70,000 rupee portion of your salary outside the legal definition of statutory wage, that 70,000 was effectively a statutory zero for your retirement security.
It seems like such a short-sighted strategy for the employee, even if it meant a bit more cash in hand each month.
It was profoundly detrimental to long-term financial health. I can't stress that enough. The entire structure heavily prioritized the employee's immediate cash liquidity at the direct expense of their post-retirement security. Companies they were effectively engaging in systemic arbitrage, and the legislative intent behind these new codes specifically names this practice as the primary reason for the reform.
Now, before the government decided to step in with this big mathematical hammer, the judiciary tried to shut down this loophole, didn't they? I'm thinking of that 2019 Supreme Court judgment.
Yes, absolutely.
Yeah.
A landmark case. Regional Provident Fund Commissioner West Bengal Vivekananda Vidamandir. Most people know it as the Surya Roshni judgment.
Right.
And this case was the immediate judicial precursor to the new codes. The Supreme Court tried to fix the problem by introducing what it called the test of universality.
Okay, what exactly did that test entail? And I guess where did it fall short? Because obviously it didn't solve the problem.
Well, the court held that if an allowance, any kind of special allowance, is paid universally, regularly, and uniformly to all employees across the board, and it isn't demonstrably linked to a specific genuine incentive or a real reimbursement, then it should be treated as basic wages just disguised as an allowance.
So it has to be included in the PF calculation.
It has to be included, yes.
So if everybody in the company gets a 5,000 rupee tiffin allowance every month, regardless of whether they bring a tiffin or not,
it's not really an allowance.
it's just wages. That's the logic.
That's the logic. But, this left immense room for subjectivity, and subjectivity leads to endless litigation. What does universal actually mean? Was a performance-linked bonus a genuine incentive, or was it just a guaranteed payout disguised to evade PF?
So it became a legal gray area.
A huge one. Lawyers and employers very quickly found new ways to customize allowances just enough. Making them conditional and marginally variable, just enough to fail the subjective test of universality. And then they could successfully argue they weren't fixed wages.
So the new codes basically decided to eliminate that subjective judgment entirely. They took the spirit of the Surya Roshni ruling, which was allowances shouldn't be used to avoid contributions, but they replaced the judge's subjective interpretation
with a mandatory objective mathematical rule.
And this mathematical rule is the core of our entire deep dive today.
It is. It's the 50% cap.
Let's define it clearly for everyone.
The new unified wage definition mandates what we'd call a high-wage, high Social Security regime. It sets a bright-line mathematical floor. It says that at least 50% of an employee's total remuneration, their gross pay, must now be considered statutory wages for calculating all mandatory contributions.
PF, gratuity, overtime, minimum wage compliance, all of it.
All of it. The era of low basic pay is, for all intents and purposes, legally over.
Okay, let's really unpack this new unified wage definition because, as you mentioned, it's structurally quite complex. It's a mechanism built on three distinct parts. You have the inclusive core, then the exclusive list, and finally the really powerful conditional inclusion. We need to dissect each of these elements to really get a handle on the new compliance environment.
Absolutely. Let's start with the inclusion. This is the non-negotiable definition of wages.
So what's the opening gambit? How does the law define it?
It starts with an omnibus, all-encompassing clause. It's very broad. It states that wages means all remuneration, so salaries, allowances, or otherwise, expressed in terms of money or capable of being so expressed, that would be payable if the terms of employment were fulfilled.
That sounds incredibly broad.
It's a deliberate, massive legal scoop. By starting this broadly, the code ensures that the burden of proof immediately shifts to the employer. The employer now has to justify why a specific payment is not a wage.
So the default assumption is, if it's money paid to an employee, it's a wage unless you can prove otherwise.
Precisely. If it's in your payslip, the law assumes it's a wage unless you can point to a specific carve-out in the law that says it isn't.
That's a powerful change in legal philosophy.
It is. And within that broad sweep, there are three specific components that form the non-negotiable foundation. These are the pillars that are always included in the definition.
Okay.
First, basic pay. That's obvious. Second, dearness allowance, or DA, which is that cost of living adjustment you often see in public sector or older contracts. And third, and this is interesting, retaining allowance, or RA, if it's applicable.
Most of us are familiar with basic pay and DA, but the specific inclusion of retaining allowance, that feels strategic. It almost seems like it's aimed at closing a very niche loophole.
It is highly strategic, and it's aimed squarely at the modern labor market. Historically, retaining allowance was pretty much exclusive to seasonal industries. Think of sugar mills, for example. It was paid to skilled workers during the off-season to make sure they'd come back when the season started again.
Right.
Now, its inclusion preempts modern attempts at creative classification. Think about the IT sector. What about payments like bench pay?
Money paid to a software engineer when they're between projects.
Exactly. You're retaining their services. That could easily be argued to fall under the retaining allowance definition now. Or similarly, certain structured non-compete fees paid during employment to ensure the retention of specialized knowledge.
So the code is trying to future-proof itself.
It is. By mandating its inclusion, the code ensures that all these new forms of retention payments contribute to Social Security. It's quite forward-thinking.
That's a clear example of trying to stay ahead of the curve. Okay, let's move to the second part, the negative list. What specific payments did the legislature explicitly exclude from this core wage calculation?
This is the critical section. This is where employers look for compliance levers. The code lists 11 specific components that are explicitly not included in the core wage calculation, provided they don't exceed that 50% threshold we're about to get to.
Give us the top exclusions, the ones the average employee actually sees on their payslip.
Okay, the most relevant 5 are 1. House rent allowance, HRA. This is still the primary statutory lever employers use to push the basic salary down, and it remains the largest permissible exclusion subject to the cap.
Still the big one.
Still the big one. 2, conveyance allowance or traveling concession value. This recognizes that these are generally reimbursements for job-related travel. 3, the employer's contribution to PF pension fund. This is just logical, right? Including, it would create a circular calculation. It would be a tax on the contribution itself.
Right.
4, overtime allowance. This is seen as remuneration for extra effort beyond standard hours, so it's kept separate from the base wage. And 5, commission payable to the employee. This acknowledges the highly variable nature of sales compensation, and it aims to keep that variability out of the fixed PF and gratuity calculation.
Okay, and the remaining 6, what else is on the list?
They cover other specific benefits. Statutory bonus, gratuity payable on termination again, excluded to avoid circularity retrenchment or retirement benefits, the value of housing or utilities supplied by the employer, which has its own cap we'll discuss later.
Okay.
Remuneration under an award or settlement, and most critically, Clause E, which is any sum paid to defray special expenses entailed on the employee by the nature of their employment.
And that, as we know, is the new friction point, the new battleground.
That's the one.
It sounds like they've really accounted for nearly every possible type of payment.
They've tried. And the crucial, often overlooked consequence of this whole structure is the universal applicability of the definition.
What do you mean by that?
The old labor laws often only applied to specific scheduled employments, or they cap the definition of employee at certain salary threshold. You remember the 15,000 rupee limit for PF?
Of course.
Well, the new code on wages applies the same single wage definition universally to all employees. That includes high earning, white collar, managerial staff. This dramatically expands the reach of these labor protection laws and fundamentally alters the compliance landscape for executive compensation.
So we have the inclusions, we have the exclusions. Now we get to the mechanism that ties them all together. The conditional inclusion, which is this infamous 50% cap. This is the moment where simple math forces a really complex legal reality.
This is what we call the deeming fiction. I love that term, because it imposes a legal truth via a mathematical formula, regardless of what the employer and employee might have written down in their contract. It's all contained in the first proviso of the definition.
Okay, lay out the rule for us simply. How does it work?
The rule is this. If the sum of all the specified exclusions, clauses A to I from that negative list, so HRA, commission, conveyance, all that, if that sum exceeds 50% of the employee's total gross remuneration, then the amount exceeding that 50% threshold is automatically deemed as part of the remuneration, and it's added back into the statutory wage base.
It gets clawed back in.
It gets clawed back in.
So the government doesn't care what you call it. You can call it a special allowance or an HRA or a unicorn bonus. If the total of all those exclusions pushes the statutory wage below 50% of the gross, the law just overrides your contract to hit that floor.
Precisely. It guarantees that the mandatory wage component, which is basic pay plus DA plus retaining allowance plus any of that clawback amount, it guarantees that component must constitute a floor of at least 50% of the total pay. It removes all the qualitative arguments. The only thing that matters is the quantitative relationship between the parts.
Okay, let's use the specific mathematical simulation. This is where the aha moment really clicks for people. Let's assume a total gross remuneration, or CTC, of 100,000 rupees per month.
Okay, a lakh. So under the old aggressive wage splitting regime, let's call it scenario A, company might have structured it like this. Basic pay plus DA was only 40,000 rupees.
Just 40%.
Just 40%, which meant the allowances, HRA, special allowance, conveyance, etc., totaled 60,000 rupees.
Yeah.
Under the old law, the statutory wage base was just that 40,000. Simple.
Now we apply the new 50% test to that structure.
Okay, so the calculation is 50% of the total remuneration, which is 1 lakh, is 50,000 rupees. That's our threshold. The sum of the exclusions in our example is 60,000 rupees.
Right.
So we ask the question, do the exclusions 60,000 exceed the 50% threshold? 50,000. Yes, they do. They exceed it by 10,000 rupees.
And that 10,000 rupees is the critical amount. That is the clawback.
That is the clawback, exactly. That excess 10,000 is legally deemed as part of the fixed wages and is pulled back into the calculation. Therefore, the new statutory wage base becomes 40,000. The original basic DA plus the 10,000 rupee clawback.
Resulting in a 50,000 rupee statutory wage base.
50,000 on the dot.
So the legal wage base for mandatory PF and gratuity jumped by 25% overnight, from 40,000 to 50,000, without the employee getting a single rupee raise in their total CTC.
That's right. The company is now simply forced by law to contribute more to that employee's Social Security. This clarity is, well, it's devastating to the old business model of wage splitting. The change is non-negotiable and it's automatic.
And this mathematical reality also has a huge impact on sectors that rely on high variable pay, right? You mentioned commission is excluded from the core wage, but this cap seems to neutralize that exclusion in practice.
It does. This is a critical nuance that a lot of compensation designers missed at first. The legislature recognized that commission is variable and it shouldn't be guaranteed, so they excluded it from the initial wage list. However, it cannot be used as a tool to circumvent the 50% floor.
Give us the sales example again. That really drives it home.
Okay, let's consider an insurance agent or maybe a real estate professional with a very high variable component. Their total remuneration is 1 lakh rupees. Their fixed basic pay might be just 10,000 rupees, a tiny amount.
Okay.
And then they have a guaranteed commission payout, which counts as an exclusion for this test of 90,000 rupees. So the total exclusions are 90,000.
And that 90,000 vastly exceeds the 50% threshold of 50,000.
By 40,000 rupees. That entire 40,000 rupee excess must be clawed back into the statutory wage base.
So the new base becomes...
It becomes 10,000, the original basic, plus the 40,000 clawback, which equals 50,000 rupees. So the organization now has to calculate PF and gratuity on 50,000 rupees, even though that employee's guaranteed fixed component is tiny. For sales-heavy organizations, this mandates a massive increase in their statutory contributions. It drastically changes their unit economics for every single high-commission employee on their payroll.
The mathematical shift is undeniable, but the consequences of this change are far more complex than just calculating a higher monthly PF amount. This shift triggers what we've called a financial earthquake across corporate India, and it particularly hits accounting standards and long-term liabilities.
Oh, absolutely. The biggest immediate financial cost, the proverbial time bomb in the balance sheet, is the gratuity liability.
Explain that for us.
Gratuity is a statutory post-employment benefit, and it's calculated on your last drawn wages. Since the legal wage base, your basic plus DA plus any clawback, is now guaranteed to be at least 50% of your CTC, the future gratuity payout for every employee increases significantly.
And we had some really striking figures on the magnitude of that increase.
We did. For companies that were operating at the very low end of the spectrum, structuring salaries with basic pay at, say, 30% of CTC, their mandatory gratuity base has now jumped from that 30% all the way up to the 50% floor.
That's an increase in the base of calculation of up to, what was it?
Up to 66%.
66%. A 66% increase in a long-term liability is something that financial officers simply cannot ignore. How does this translate onto the company's balance sheet immediately?
This is where we get into some specialized accounting terms, but they're absolutely crucial for understanding the real-world impact. Companies that adhere to the Indian accounting standards, specifically Ind AS 19, which governs employee benefits, they must perform a retrospective actuarial revaluation of their defined benefit obligation. This is known as the present value of defined benefit obligation, or PVDBO.
Let's break that down. What is PVDBO in simple terms?
Think of PVDBO as the best estimate of how much money a company needs to put aside today to meet all its future retirement promises, like gratuity, for all its current employees.
So it's a projection.
It's a complex projection, yes. It involves calculating the probability of employees staying, their expected salary increases over time, their expected retirement age, and since the base of that promise, the statutory wage, has permanently increased by up to 2/3, the PVDBO calculation just skyrockets.
And that increased liability hits the profit and loss statement.
Yes, immediately. In the very year the codes are implemented. It results in a significant one-time non-cash charge against the company's profits. It's an accounting recognition that the long-term cost of their workforce has just legally increased, and it forces transparency in their books.
So it's not necessarily cash out the door today.
Not today, no. But it's a necessary adjustment that investors and the market watch very, very closely.
And beyond the P&L hit from existing employees, the Social Security Code also changed the rules for contract hiring, didn't it?
It did, specifically concerning fixed-term employees, or FTEs. Historically, companies loved using FTEs because they rarely stayed the mandatory 5 years that were required to qualify for gratuity.
The 5-year cliff.
It's exactly, the 5-year cliff. The new Social Security Code mandates pro rata gratuity for FTEs, even if they serve for less than 5 years, all the way down to just 1 year of service.
So the loophole is closed.
The 5-year loophole is gone. This directly raises the statutory cost and the liability associated with contract or project-based hiring. It makes it more expensive.
Okay, let's shift from the long-term liability of gratuity to the immediate cash flow dynamics. I'm talking about the Provident Fund, or PF.
Right. So when the wage base automatically mandates this 50% floor, the effect on PF is dual and immediate. First, the employer's mandatory PF contribution, which is 12% of that statutory wage, increases. This is a direct, tangible increase in the company's operational costs month on month.
And second,
the employee's mandatory 12% contribution to PF also increases proportionally.
now, this is where we need to introduce a really critical counterpoint. I understand the long-term benefit of higher savings, of course, but for a young employee, or maybe one who is relying on immediate cash liquidity, doesn't this policy effectively act as a mandatory pay cut? It reduces their immediate take-home pay, even if their CTC hasn't changed.
That is absolutely correct. And it is the primary point of friction the government is facing with this rollout. The employee's mandatory contribution rises, and that leads to an immediate reduction in their disposable or take-home income. The government, through this law, is fundamentally prioritizing long-term Social Security and savings over immediate consumption.
It's a choice they're making for the workforce.
It's a mandated increase in the savings rate for the entire formal workforce. And politically, that could be a very difficult pill to swallow for workers who are cash-strapped in the present. It forces financial prudence, whether the employee desires it or not.
Precisely.
And this policy also has major implications for the higher pension scheme that was recently rolled out by the EPFO.
The Employees Provident Fund organization. How does the 50% floor interact with that higher pension option?
Well, for employees who opt to contribute PF based on their full salary rather than the old statutory ceiling of 15,000 rupees, the new definition confirms that their contributions must still adhere to this mandatory 50% floor calculation.
So what's the effect?
It means a significantly larger amount of money will be diverted from the employee's lump sum PF corpus into the pension fund. Now, this secures them a higher post-retirement monthly pension, but it also reduces their final lump sum PF withdrawal amount. The 50% floor just ensures that even those higher pension contributions are calculated on a substantial, legally mandated base.
And finally, what about the cost of employing international workers or expats in India?
This is a niche, but a very high cost impact. Unlike Indian employees, international workers generally do not have that statutory PF cap of 15,000 rupees applied to their contribution base. PF is payable on their full wages.
Which can be very high.
Very high. And expat compensation packages often involve extensive high-value allowances, HRA, travel, international schooling allowances, which, under the old system, could be excluded. The 50% rule now consolidates a significant portion of those typically high allowances into the statutory wage base. The result is a dramatic, unavoidable increase in the employer's liability for employing high-earning expats in India.
We've established the mathematical rigor of this 50% cap, but the definition of wages isn't monolithic, is it? The new code includes several crucial provisos that actually change the calculation based on the specific context of the payment. This shows the law is designed not just for retirement security, but also for fairness.
That's a great point. This expansion of the definition for specific purposes is fascinating.
Let's look at the second proviso. This deals directly with gender parity and payment protection. Why did the legislature feel the need to expand the definition of wages for these two specific issues?
Well, the lawmakers realized that simply enforcing the 50% floor for Social Security wasn't enough to prevent things like pay discrimination or delays in final payments.
Right.
So the second proviso expands the definition for two very specific purposes. One, ensuring equal wages for all genders for the same work, and two, ensuring the timely payment of wages.
So when a regulator is checking for discrimination, they use a broader, more inclusive definition of wages.
Exactly. For these two checks, the law pulls back 4 key allowances that are normally excluded from the core wage calculation.
Which ones?
The 4 items are conveyance allowance, house rent allowance, HRA, overtime allowance, and any remuneration payable under an award or a settlement.
Can you walk us through a detailed scenario of how this thwarts masked discrimination? Let's use HRA as the lever because that's always been the main tool.
Okay, perfect example. Let's say an employer wants to pay employee A, who is male, more than employee B, who is female, for the exact identical role. Under the old system, the employer could give both employees an identical basic pay of, say, 40,000 rupees and claim equal wages.
On paper, it looks fair.
On paper, yes. But then they would structure the rest of the package so that employee A gets a 30,000 rupee HRA and a 5,000 rupee conveyance allowance. Meanwhile, employee B gets only a 10,000 rupee HRA and no conveyance.
So employee A's total pay is 75,000 and employee B's is only 50,000. A huge gap.
A huge gap. And under the old system, the employer could argue they paid equal basic wages. But under this second proviso, when the government or a court checks for equal pay, it adds HRA and conveyance back into the calculation.
So the comparison base changes.
It changes completely. The wage base for comparison jumps to 75,000 for employee A and 50,000 for employee B. The disparity is immediately exposed, and it forces the employer to justify the difference. The law mandates an effective total remuneration model for testing gender equity, preventing employers from using allowances to mask pay gaps.
That is a really powerful anti-discrimination defense. And how does this broader definition help with payment protection?
This addresses historical abuses, where employers would delay paying allowances when an employee left the company. The code mandates that all terminal dues, which must include all wages, have to be cleared within 2 working days of resignation or termination.
2 working days. That's a tight deadline.
It is. And by broadening the definition of wages here to include HRA and conveyance, the law ensures that the entire paycheck, including these major allowances, is protected by those strict legal timelines. An employer can no longer withhold a large HRA payment, claiming it's not part of the wages that must be paid promptly.
Okay, moving to another unique aspect, payments in kind. What is the rule regarding remuneration that's paid in the form of goods or services, like housing or utilities, rather than cash?
This is governed by an explanation to the definition, which introduces the 15% cap. Remuneration paid in kind, like the value of housing, electricity, medical services, or other amenities provided by the employer, can only be deemed part of the wages if its value does not exceed 15% of the total wages payable.
What's the historical rationale for a rule like that? It seems a bit archaic.
It's to regulate what was historically known as the truck system.
The truck system.
Yeah, where employers would pay workers in goods or tokens that were only redeemable at the company store, effectively trapping them in a cycle of debt.
But in the modern context, the 15% cap serves a different purpose. It protects the employee's cash liquidity.
I see.
The law ensures that cash wages must constitute the vast majority of the pay. So if an employer provides subsidized housing that's valued at 50% of the employee's pay, only 15% of that value can be counted towards meeting the statutory minimum wage requirements. It ensures the worker has sufficient cash flow for all their other external living expenses.
We've established that this 50% rule is mathematically tight, and it seems difficult to evade. But complex legislation always creates a new point of contention, doesn't it? A new area where employers will seek flexibility. What is the new litigation frontier created by this definition?
Without a doubt, the new friction point is clause of the exclusionary list. This is the special expenses loophole.
Remind us what Clause E is. Clause E excludes any sum paid to the employed person to defray special expenses entailed on him by the nature of his employment.
So in its purest form, that's just a standard business reimbursement, right? Paying for business travel or a uniform, it's logical to exclude that from retirement contributions.
Exactly. It's designed as the catch-all for genuine, documented business reimbursements. However, this clause is widely viewed as the new potential loophole, particularly in the post-pandemic work-from-home era.
How will employers try to exploit this? What's the strategy?
They will attempt to reclassify significant chunks of flexible benefits or allowances under this special expenses, heading to keep them out of that 50% cap calculation. For example, remote work stipends, internet cost reimbursement, mandatory mobile phone usage, specialized software subscriptions.
Even furniture allowances for home offices.
All of it. It could all be pushed under clause.
Why is that so attractive for them to do?
Because if an employer can successfully claim that, say, 20% of the employee's salary is now a genuine special expense reimbursement, that 20% is excluded from the total exclusions calculation for the 50% cap. This gives them more breathing room to retain large exclusions like HRA without triggering the clawback. The battle is simply shifted from defining special allowance to defining special expense.
But the government must be anticipating this. The enforcement mechanism has to be designed to combat it.
It is. The new system combats it by demanding rigorous proof.
What kind of proof are we talking about?
The enforcement official, who is now known as the inspector cum facilitator, will not accept flat sum fixed payments. If an employer provides a fixed 5,000 rupee remote work stipend every month without requiring a single bill or expense claim, the inspector can just deem it disguised wages.
So you need receipts.
You need documentary evidence, bills, receipts, utilization logs, formal policy documentation. You need to prove that these are genuine expenses incurred by the employee on behalf of the employer's business because of the nature of the employment. If that proof is lacking, the amount is immediately added back to the wages, increasing the compliance cost. The burden of proof lies entirely with the organization.
This entire regulatory overhaul suggests a massive operational shift. The core objective of unifying the wage definition was really to move India from an often arbitrary, subjective, litigation-based system of compliance to a standardized, objective, formula-based system.
That is the philosophical goal. Certainty over flexibility. The reform ends the endless legal ambiguities that are inherent in subjective judicial interpretation, like arguing over the test of universality in court for years, and replaces it with objective, verifiable math. And having one single definition for PF, gratuity, overtime, and minimum wage fundamentally simplifies payroll architecture for large employers.
But implementing complex math across millions of enterprises, from huge multinational tech firms down to small manufacturing units, must be a logistical nightmare. How is a central government even tackling enforcement on this scale?
The implementation relies almost entirely on sophisticated digital enforcement.
Not people.
Not people. The system is run through the government's centralized platform, the Shram Suvita portal. Enforcement is driven not by site visits, but by algorithms.
Tell us how that algorithm works in practice.
So employers have to submit detailed payroll returns that contain categorized payment codes for every component of salary. The system is programmed to automatically calculate the total sum of all the codes that are classified as exclusions, HRA, conveyance, commission, and so on.
Okay.
It then compares this sum against the total gross remuneration. If the sum of exclusions reported exceeds 50% of the total pay, the system instantly flags that return as a non-compliant structure.
So it's automated.
It makes evasion significantly harder and allows for auditing in real time. It completely replaces the old system of laborious, infrequent physical inspections.
So compliance becomes a matter of passing a mandatory digital audit rather than dodging an inspector. And speaking of inspectors, their role has changed completely.
Completely. The old punitive labor inspector is being phased out and replaced by the inspector cum facilitator. Their role is shifting from catching violations and levying fines to advising companies on how to comply with the new formula. They facilitate understanding, but the algorithmic enforcement is the real power behind this law.
Let's look at the sectoral impact, starting with the biggest users of the old wage structure, the IT and services sector.
The IT and services sector is profoundly affected. Historically, they maximized employee liquidity through these high flexit baskets and low basic pay, often keeping the statutory wage in that 30% to 40% range. The 50% rule is a direct torpedo to this model.
So what do they have to do?
They are forced into mandatory payroll audit and restructuring. Every single element in those flexible benefit plans that isn't a genuine, documented reimbursement, things like flat sum health or wellness allowances, will be automatically consolidated into the wage base. This dramatically increases their compliance costs for both PF and gratuity.
What about the micro, small, and medium enterprises? The MSMEs, which make up the bulk of employment in the country.
MSMEs face the steepest adaptation curve here. They often relied on very informal or lump sum payment structures and frequently avoided or minimized PF and gratuity compliance entirely. The combination of the mandatory 50% floor and the stringent digital reporting via the Shram Suvita portal makes that non-compliance model obsolete.
What's the bottom line for them?
The mandated 50% base will likely increase the overall formal wage bill for MSMEs by an estimated 5% to 15%. It's forcing many of them into formalization for the very first time.
And what about the most novel sector? The gig and platform economy. How does this deep dive into wages affect companies like ride-sharing or delivery platforms whose workers are typically classified as independent contractors?
That's a great question. While gig workers are currently classified distinctly from employees, the definition of wages becomes critically relevant as a risk hedge for these companies.
A risk hedge?
Yes. If a court, following legal precedents we've seen set in the UK or the US, ever rules that gig workers in India are in fact employees under the law, well, the platform's retroactive liability could be astronomical. The code forces these platforms to maintain detailed records of all payments, which would be scrutinized against the minimum wage floor and the 50% rule if that reclassification ever occurs.
So the record keeping itself is a risk?
Essentially, yes. The mandatory record keeping is a sword hanging over the gig economy. It demands transparency, even if they're currently exempt from the 50% rule.
Finally, in terms of regulatory friction, is this 50% floor fixed in stone forever, or is there some room for future adjustments?
The central government wisely built in regulatory flexibility. They hold the power to notify a percentage other than 50% in the future.
So they could change it.
They could. This provides the executive branch with a dial, really, to adjust the Social Security burden based on economic cycles. If there's a recession, they could theoretically allow a higher percentage of exclusions to stimulate liquidity, or vice versa if the economy is booming.
But that flexibility, if they ever use it, creates a major compliance headache for multi-state employers, doesn't it?
A massive one. Labor is a subject in the concurrent list in India's constitution, which means both the central and state governments can make laws on it. So if the central government maintains the 50% floor, but individual states decide to notify different percentages, say one state allows 60% exclusions to attract investment, while another sticks to 50%.
It creates a compliance nightmare.
A total nightmare. Imagine you're running a major BPO operation with centers in Bangalore, which adopts 50%, and Kolkata, which adopts 60%. Your central payroll software instantly breaks. You now need two separate validated pay structures for the exact same job profile within a single national organization. The risk of state divergence is the biggest operational hurdle that's yet to come.
This entire deep dive has revealed that the new unified definition of wages in India is so much more than a technical law. It's really a profound policy statement.
It absolutely is. It signals the unambiguous end of the low basic, high allowance era and enforces a mandatory regime of transparency and standardization. By creating this objective mathematical test, the state has clearly prioritized long-term Social Security and savings,
Ensuring employees build a robust corpus for PF and gratuity.
over the short-term goal of maximizing immediate cash liquidity. It's a clear choice.
So for you, the employee listening, the key takeaway is really simple. Your legal wages are now protected by an explicit mathematical floor. You must audit your own pay slip after this is implemented. The sum of your basic pay, plus your dearness allowance, plus any allowance that is not a genuine reimbursement, must equate to at least 50% of your total pay. This shift ensures your retirement benefits are calculated on a substantial base, not an artificially low one chosen by your employer.
And the focus has shifted entirely. It's moved from qualitative legal arguments to quantitative compliance. The old battle was about suppressing the basic salary component. The new battleground and the potential loophole lies in the rigorous documentation of these special expenses exclusion under Clause.
Which leads us to our final provocative thought for you to take away. As hybrid and remote work becomes a permanent feature of the labor landscape, the very definition of the workplace is dissolving, and with it, the lines of expense accountability are blurring. The next major legal question you might face regarding your pay is this: where does the nature of employment end and personal cost begin? And how will your home internet bill fundamentally redefine your statutory wage?
That fight, the fight over whether your remote work allowance is a genuine documented business expense or simply a piece of disguised salary, that will be the ultimate test case for the efficacy of this new digital enforcement regime in the decade to come.
Thank you for joining us for the deep dive into India's new 50% wage floor. We'll be watching those digital audits very closely.